Jennifer, I'm back. Could you close the sharing screen, please, so that I could see when other people are seeming to get back together here? Okay, thank you. I'm looking to see who we're missing still. Looks like only one committee member yet to reconvene. Okay, we're back. Oh, it looks like we have all the committee members present. I'm going to call the meeting to order of the FFE and ask Jennifer Clark to do the roll call, please.
Okay, Nick Griffith.
Yes, here at Allegan County.
And I believe Joshua Sledge is still not attending this meeting, correct?
That's correct.
Sandy Doctor.
Here, Kalamazoo County.
Dan Dement.
Here, Allegan County.
Dean Burgee.
Here, Kalamazoo County.
Randy Eberts.
Here in Kalamazoo County.
And then Bob Salisbury.
I'm here in Watauga County, North Carolina. So could we have a motion to excuse Josh?
So moved.
So moved.
Support.
Motion and support. All those in favor signify by saying aye. Aye.
Aye.
Aye.
Anyone opposed? Josh is excused. Jennifer, can you introduce guests?
Yes, I will. We have on with us Mayor David Anderson, City Attorney Clyde Robinson. Looking around, I saw Steve Brown from our FFE manager has joined. And I believe Nina Porter is on to take notes for us. And then Chris Ruppel is here representing as a consultant.
Okay, and Chris, do you have it? Can you introduce the Marion and Zhang participant, please?
We have from Zhang Financial, Lynn Zhang, Rob Fishugal, Katie Richards, and Kyle May.
Okay, thank you. Next item on the agenda is to review the minutes of the February 24th meeting, which are included in your package. Could I have a motion to approve those?
Move they be approved.
Support.
Motion support. Any discussion or corrections about the minutes? Hearing none, all those in favor of approving them signify by saying aye.
Aye.
Aye. Anyone opposed? Minutes are approved. So next, Jennifer, I guess you'll do assets at March 31st, correct?
Yes, I will. Our assets as of, sorry, I have to move my controls a little bit. Our assets as of March 31st was 97,141,000. They were split between BlackRock and Jennison at this time. We're looking at approximately 50% target split between those two. And by the end of the quarter, we were within those targets. You will see that we had to do a rebalance as we went along to make that target hit. And we have $76,000 in cash at the end of the quarter.
Okay, any questions from anyone? If not, Rob, take us through asset or investment performance, please.
Okay, well, thanks, Bob. Thank you, Jennifer. So market, as Jennifer mentioned, market value of the assets, 97.1 million, up from 95.8 million at the end of the year, up 1.36%. The return on the investments weighted for the quarter, net of management fees, was 1.5%. Since May 1st, net of manager fees, the return has been 20.02%. Equities were just over, they were 50.6% at the end of the quarter. During the quarter, the equities return, the S&P 500, 6.17%. since May 1st of last year. S&P 500 or the BlackRock product up 41.93%. Fixed income at 49.3% of the portfolio, returned a negative 3.57% during the quarter, and since May 1st of last year has returned a negative 0.86%. The inflation adjusted return for the quarter was a negative 0.19% as inflation rose. It was 1.69%. Since May 1st of last year, the nominal return was 20.02, as I mentioned, but the real return since May 1st of last year, positive 16.71%. Jennifer, if you would scroll to the pie chart. This portfolio, again, roughly 50-50 fixed income equity, all domestic, all S&P 500 exposure, no foreign currency exposure. We've mentioned we're pretty close on the allocations. Jennifer mentioned a rebalance that was needed. On the fixed income side, on the Jennison side, the numbers vary slightly from some of the other portfolios with Jennison exposure, but roughly the same. The duration is below their benchmark. The index, Bloomberg Barclays, is at 6.3 years. Portfolio is at 6.07. On the right-hand side, the 3-month attribution, you can see roughly flat, a little bit under the index. Not much to talk about. We have talked about sector allocations with Jennison, the fact that they're underweight on U.S. Treasuries and we're overweight finance and industrials. The underweight to Treasuries here, a little bit less than a couple of the other portfolios. I'll kind of jump ahead on the Jennison recap. One of the things they did mention is that the risk reward for riskier assets just doesn't look great at this point, suggesting they're going to move up in terms of quality. So I would expect that underweight to Treasury, currently at 6.0 at the end of March, to be decreased when we take a look at this and review the June portfolio. Next one, Jennifer, simply showing, in this case, a monthly return. Last quarter, again, up 1.5% portfolio. The next slide is the 4 quarters. Timing's everything, starting May 1st of last year. The next is the allocation, simply again, underscoring the fact that we're slightly overweight equity, slightly underweight Jennison fixed income. This page, the only thing to explain here, and Katie, correct me if I'm wrong, it'll actually be on the next page, with the fact that we started the portfolio and the trade didn't clear for the S&P 500, so we'll see BlackRock with an outperformance to the benchmark. I'm sorry, I jumped ahead of myself. That's the next page, but that's the explanation for, thank you. So when you see these since inception numbers, it looks like BlackRock blew away the S&P 500. That's not the case. They track very closely to it. It was a 1 or 2 day variance as the S&P 500 investment cleared, which accounts for that. Jennison, slightly below their benchmark, negative 0.2 for the quarter. Since inception, May 1st of last year, actually positive 0.19%. So this is the recap for the quarter. Again, portfolio up 1.5%. The index, composite index for this portfolio was 1.37. So outperformance in the quarter of 0.13%. Again, the since inception outperformance of 1.21 is overstated because of the timing of the S&P investment. I think that is it in terms of the performance. Are there any questions?
Okay, hearing none, Rob, I'm going to jump ahead. And why don't you go ahead and do the derivative reports and Jennison overview, please, while you're on.
Sure. Page 23, well, 22. So that, yeah, this is BlackRock. BlackRock uses very modest amounts. It totaled 0.6% for this portfolio, consistent with the other three that we've reviewed, four actually that we've reviewed today. Nothing to report there. The next page is Jennison. Jennison, stronger use, and consistent with the other portfolios, Jennison dramatically reduced their use of derivatives at 12/31/2020 and has brought that back up to more historic levels. At the end of the year, the net notional value was almost nothing, less than 8% of the total portfolio. As of the end of March, that's back up to levels that we've seen, which has been low teens. In the case of this portfolio, it's 13.8%. In terms of Jennison, I think I referenced earlier, I'll repeat myself. Jennison is cautious on the economy. They state the easy Fed money is a bit of a concern. They pointed out that the risk return to riskier fixed income assets has evaporated. The fact that the credit spreads pre-pandemic are actually wider than they are right now, meaning investors have definitely had a risk-on appetite. And we know that as we take a look at the first quarter performance. US Treasuries did poorly, AAA bonds did very poorly. The only thing that did relatively well was US high yield that was up 0.85% in the quarter. So Jennison has stated that they will likely be moving to higher quality. So I would expect to see that Treasury underweight to be reduced over the next quarter. They also state that they expect reflation. So they mentioned we can expect slightly shorter duration versus the index. We're already short to the index being Bloomberg Barclays aggregate, that's 6.3 years. This portfolio is 6.07 years, 0.23 year variance. If they follow through with the commentary stated here, we should see actually a bigger gap when we discuss the June results.
Okay, Rob, thank you. I'm going to go back to investment performance for just a moment. So for those of you who sat in on the city meeting and now see the FFE meeting performance, the FFE has not performed as well as the city. And the obvious reason is that we have a portfolio that's only 50% weighted to equity in the FFE versus the 70% weight to equity in the city. And the reason for that is that we, as a committee, felt that it's not appropriate to take a full asset allocation with a 70% equity exposure at a point when there's an uncertainty as to the future cash needs of the FFE portfolio. So it really comes down to saying that until such time as we have a full endowment that we feel comfortable has a 30-year time horizon, does not have significant cash requirements, we are going to have a more conservative asset allocation. And the result when the stock market is performing well is that we will have underperformance. But I think it's just important that representatives of the city and the FFE understand why this is happening. And it's really a deliberate action on the part of the committee reflecting sort of the early stages of the FFE. I'll stop and ask if any other committee members or anyone from the city wants to comment about this performance. Okay.
Steve, Roger, just wanted to thank you for lifting that point up, and it's probably going to require reiteration at some future meetings as well. It's a really important point to make and one that clarifies the committee's position on this fund compared to the city. So thanks very much for doing that.
Okay, my pleasure, Steve. And if the question comes up at all in the board and everything else, would be glad to elaborate on that. But it's just important that that's why we're pursuing it that way.
Well, Bob, I think it is worth mentioning, though, that it's better than what we see in that table from another committee, right? The 1.3%, we have 1.5. Is that what I'm seeing here for the first quarter?
Oh, so you're comparing it to the, like the perpetual care?
The performance of a 50/50 S&P 500 and index fund for the bonds.
Oh, yeah. So sure, of course, Randy, because we had a great performance by DFA in that quarter. So
Well,
maybe
no,
it'll happen.
Yeah, we did. And well, actually it's BlackRock and Jennison here for FFE.
Right.
And in the table for just an S&P 500 index and a 50/50 there, we have a 1.3 and here we have 1.5 for the 3-month in the FFE, right?
Right. Okay.
Yeah, so we're doing a little better than the, than a typical index fund would do at a 50/50.
Right. And we don't have and for clarification, we don't have the exposure to DFA. So I was wrong there. Thank you. Anything else on performance from any committee members? Okay, Chris, I'm going to bypass articles of interest because I think we discussed that quite a bit. I don't think we need to talk about due diligence and education and governance. There are a couple of items that I'd like to talk about in new and old business. Asset allocation is an issue that we've been discussing throughout the morning. And we discussed it in the city meeting, but I think it's important that we make a comment in terms of the FFE. As I've said, that we as a committee are going to have to answer the question of whether in considering asset allocation, we want to consider environmental, social, and governance issues. And the FFE may have a different position on that than would the city for the pension and the other post-employment benefits. So Steve, at some point, we probably should get some direction from the FFE board about what their thoughts are as to pursuing strictly total return goals versus considering some other social factors. And I don't know what the best way to get that feedback, but at least I want to introduce the idea that we should be thinking about it.
Thank you. This is Steve Brown. I agree completely. There is a history of this being discussed at the FFE board level, and where it's been left, to my understanding, is that now is not the time to act on that because the endowment isn't complete, but that the future will definitely have those conversations. So what I would want to do is maybe just daylight that topic again with a time horizon, and then to the extent possible, if we could avail ourselves of this group for guidance or perspectives or any intentions that exist for the other funds that it oversees, we would certainly appreciate that guidance and context. And then that will, I can imagine a board level work group doing some learning and some exploration in order to present a recommendation to the board itself that would then, of course, trickle up or down, however you want to look at it, to this to this group. So certainly no sense of urgency on that, but definitely from a value standpoint, I think I speak for the board in saying there's a real interest in making sure that we're, respecting all of the bottom lines that matter most and align with the FFE. So currently, of course, that's sort of a single bottom line approach. But as we, track with the culture and with the economy, I think that the ESG filter is one that we want to keep our eyes on for sure.
Okay, so we'll maintain a dialogue, and as you were talking, it occurred to me that we are going through this discussion with a community foundation, and they have a different perspective, obviously, than would have just strictly from the pension side. So maybe the way that we move with a discussion with the community foundation could help inform or provide some feedback to the FFE as to what direction they're going, and maybe that can help the FFE when they're thinking about that.
Steve Brown, yeah, and I see Treasurer Carol nodding her head as well, and so I think that conversation, it's great to have all of these all of these heads at the table, as it were, and all these voices in the conversation, and really understanding the different filters and lenses that it can be seen through. You know, a positive screen versus a negative screen versus some of these other ideas that are sort of developing. So we want to be informed, and we want to move, you know, intentionally with permanence and, you know, sustainability and perpetuity, certainly front and center.
Good. Well, since you mentioned permanence, that was going to lead to my next question. Is there any new information about future contributions coming into the FFE?
Not at this time. We would expect, certainly by the end of this year, to have some more information to share. And I apologize that I can't really go into any depth on that at the moment. So.
So I understand it gets to be a very sensitive issue to be discussing, but I think it's important as we get any kind of information, it'll be helpful to our committee because that helps inform the asset allocation decision and where we would go with that. So until such time as we get any new information, I think we're going to stick to the 50-50 allocation simply because that is a more conservative circumstance given the state of the foundation at this point in time. Anybody else from the committee or otherwise want to comment on the issue of asset allocation or contributions? If not, there was another item that I had put down for old business on my list, which has to do with insurance. The note that I had from Steve Vincenzi is that the insurance company is still reviewing some of the issues that were previously raised about the insurance coverage for committee members. And they don't have answers yet, and there's still more work to be done. So that was the message I had from Steve. Steve Vincenzi. I don't know if Steve Brown, you have anything to add to that?
Thanks for asking. No, I don't. That's the same understanding that I have now. It's been a difficult journey that continues.
Okay, thank you. And future meetings are noted on here. And as we said in our previous meeting, we'll stay tuned as to whether the August meeting will be an in-person meeting or a virtual meeting. I'll go to around the table. I have nothing
Excuse me,
further.
Bob.
Hey, Bob.
Yes.
I don't believe we approved the expenses yet.
Oh, I'm sorry. I jumped away from the expenses. Thank you very
Thank
much
you,
for
Nina.
bringing me back to that.
I was like, should I jump in?
Oh, and
I will.
maybe I skipped that whole section. I'm sorry. When I jumped
Yeah.
ahead with Rob, I did. So,
Well,
okay, thank you.
I will keep it brief. It's not much to share with FFE.
Okay, thank you for catching me on that, Jennifer.
So the expense report for FFE is pretty simple. We currently aren't really funding. We have very little expenses coming out of the Foundation for Excellence endowment. We have our consulting with Marion Capital. We have custody fees, of course, State Street for holding money. We have investment manager fees. I believe we will see audit fees when we get invoices come through for that. We don't have any at this time. So total expenses of $71,366. So I would be looking for approval of that if there's no questions.
Could I have a motion to approve those?
Move that be
So
approved.
Support.
A motion and support. Any discussion, questions? If not, we'll do a roll call, please, Jennifer.
Okay. We have Nick Griffith,
Yes.
Sandy Doctor,
Yes.
Dan Dement,
Yes.
Ian Burgee,
Yes.
Randy Eberts,
Yes.
and Bob Salisbury.
Yes. Motion passed. Thank you. How about cash flow then, Jennifer?
Cash flow, again, fairly simple. We have, or not much to share, disbursements only, and other than our investment earnings, which obviously we covered at length. So total fund balance for the FFE at the end of this period was 97 million.
So really, at this point in time, we aren't, the FFE found it, or at least the endowment isn't funding any of the needs for the city at this point in time, because that's coming from separate sources of funds.
Correct. In 2021, that'll continue. We will be funding the FFE, or we're still getting separate donations for the
Okay.
city support during 2021.
Great. Okay, how about rebalancing then?
Rebalancing, a little bit more active with between the two funds for each month here. You'll see a rebalance from, this is the March report here. Yeah, we don't show you each month on this page, but we had to do a hard, what we refer to as a hard rebalance to make sure we hit our targets between the two funds in March. So that's been done, and we, at the end of the day, can't get exact percentages, but we are pretty close to actual.
Okay, any questions of Jennifer at this point? All right, I think I've covered everything on the agenda before I get to around the table. Someone interrupt if I miss something. So I have nothing on the around the table. Randy, do you have anything?
No, nothing, thanks.
Dan?
Nothing.
Dean?
Nothing here, Bob.
Sandy?
Nothing.
And Nick?
Nothing. Thank you.
Okay, Steve Brown, anything? Clyde, anything? Clyde, you're muted, so we can't hear you.
Did you ask for public comment? I don't believe you did.
Oh, we didn't. Okay, I missed public comment. Thank you very much for catching that.
Thank you, Clyde.
Can we do, are there any public comments?
There are no public comments at this time.
Thank you. Thanks for the reminder, Clyde. And David, do you have anything that you'd like to bring to us? Anyone else? If not, I'm going to adjourn the meeting and thank everyone for their participation and input. It's been a busy time, and have a good summer, and stay tuned for more information coming on the various items that we discussed.
Thanks, Bob.
Bye, everyone.
Thanks, Bob.
Thank you all.
Thank you.